Distribution provided by Cloud Sigma, the cloud that adapts to you. Visit cloudsigma.com/thisweekin for a free $200 credit.
Today's episode of This Week in Startups is brought to you by New Relic. Use promo code TWiST and get a free month of New Relic Pro. To redeem, visit newrelic.com/thisweekin and see why thousands of developers worldwide don't deploy without it. And by Turnstone. More than furniture, we're an experience. Go to myturnstone.com/twist to learn more and receive 10% off your first order.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Money is the root of all evil. What? Funny how it feeds my people. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
Two or 3 years, I assume some people have seen the show? A couple of people? Everybody's seen it. Great. Awesome. So we were thinking over the summer, why do we do the show, and why do we do the launch festival in March? We came to the conclusion we do this really because we're very interested in founders and startups and entrepreneurship and technology. Obviously, we're passionate about that space. The team of about 5 people who work full-time on these projects with me. But we also do it because we want to try to see, as Naval, anybody see Naval on the program? The Naval interview, right? A bunch of folks, one of the best guests we've ever had. He said something very interesting on the program, which was he was trying to become the most helpful he could to startups. And I just thought, wow, well, that's a great mission. I'll just steal that. And so we're trying to do the best we can to be the most helpful. And one of the things we thought would be great was just to get together with the audience. And this is the first time we've done it. Phil from Evernote will be back on the program on January 8th. We'll give you guys first shot at the... 11th. Sorry, January 11th. And we'll give you guys first shot at the tickets. Hey, Karen, can we make sure that happens? So just email these folks first, and then we'll give you guys, since you guys are coming to the inaugural event. And tonight is going to be like any other episode of the show. Jeff and I will just have a conversation. It will last as long as it's interesting, and you guys will get to ask questions too, which will be a first for the show. And so hopefully we don't have any technical issues. And we're doing, Jeff was nice enough to offer lunch to one of the people who come, so you all have raffle tickets. Somebody will get to have lunch with Jeff Clavier, which is what we would call a BFD, a big effing deal. Get to have lunch, and you're paying for that lunch, correct? And it's going to be at a good place? Yeah, it's going to be a really good place. I suggest you pick a really expensive sushi place. Alcohol's included. You're French, right? So, of course, it has to be dinner. Then it has to be dinner. So, okay, so it's been officially upgraded to dinner.
It's an option.
It's an option, okay. And we're live streaming this, of course, but I'm going to have to do some thank yous and do some ads. I know, actually, some people like when I read the ads. Yeah. Well, let me start by first thanking my friends at Rockit Space. They've been really nice to me. When I tweeted one day that I needed to tape some episodes here, they gave me the space right up there in the nice little loft up there. And, of course, they did it free of charge and just were incredibly graceful. And they did this all for us as well. And they took it upon themselves to buy like those $3 Italian sodas and put out like the little flags on the cheese and like 18 different types of ham. I think you can see the diligence that Rockit Space put into this event, which is the same diligence they put into hosting the startups here, which is why they're perennially sold out. This is the best place you could ever hope to start your company. So let's give a big round of applause to our friends at Rockit Space. It was really a class act for hosting the event, and they made it so easy for us. And then also I just want to thank my friends at New Relic who provide server monitoring on email. really simple to use. Skullcandy, Spotify, Nike, Zillow, Vonage, all these great people use it. I use it at my companies, newrelic.com/thisweekin. You'll go get a free t-shirt there, one of the free This Week in Startups t-shirts. And My Turnstone, which is very interesting. I actually found out about My Turnstone when I came here, and I said, these are gorgeous desks. I need to get desks like this for my office. And we bought a bunch of these for our office, and then they wound up sponsoring the program, and they do a great job. So big thanks to New Relic and My Turnstone. Big round of applause for those guys. Thank you, everybody. Thank you. So my guest today is a prolific angel investor, and really has been doing this for a while. Actually, when I met him, there really weren't any angel investors. It was so early in 2004, 2005 when you started investing, and that was a really down time in the internet business.
Yep, no one wanted to invest. And
Nobody wanted to invest in 2004, 2005. This was coming off of the horrible crash of 2000, the terrible tragedy of 2001. People thought the internet was a bit of a fraud at that time. You didn't. You leaned into it, and I guess you raised the fund at that point, or you had your own money you were investing?
No, that was my own money. So quick background. I was born in France. I'm actually now a US citizen. And I'm a CTO by training, did a startup in the financial services market, which was acquired by Reuters and stayed for a while until 2000 when I made a move to VC. Very bad timing because it was at the end of 2000, not at the beginning. And I was a traditional VC for 4 years, and then in 2004, left the fund to start SoftTech. And like you said, at that time, no one wanted to invest in consumer internet, but no one wanted to fund the consumer internet fund. And so I just invested my own money, putting my money where my mouth is, for about 3.5 years until 2007 when I raised one of the first macro VC funds.
Yeah, and some of the first investments were?
So BuzzNet in Los Angeles was one of my first investments. Feedster, which was this RSS search engine. I mean, they're all gone, but there was a time when RSS search engines were actually popular.
That was a really interesting time. How many people remember being at a conference and looking at laptops and seeing everybody had Technorati out and was searching Technorati? Anybody remember that? Nobody remembers that? A couple people nodding? I mean, that was...
They weren't born yet.
I mean, it is a world away, but I mean, at the time, this was no Twitter, no Facebook.
Blogs.
There were just blogs, and people would be on Technorati or Feedster typing in the keyword, we're at lay blogs, or we're at this conference, the TED conference or whatever, and looking for somebody who had written a blog post.
Yep, and those were the days where we thought that, everybody was going to be blogging, and therefore we needed a new search engine or set of search engines because Google wouldn't cut it. Turns out we were wrong. But just a few months later, I invested in Truvio, which was my very first sort of success, which was one of the first video search engines back in 2005. Which, before YouTube, essentially. So yes, there was a video, world before YouTube. And those guys were acquired by AOL after 11 months. And there was a massive return for me. And that sort of put me up on the board of people who were successful. And I was lucky to get into a bunch of good deals that ended up being acquired early. At that time, people were talking about, build to flip. If you remember those terms.
Right, absolutely.
And no, they were not built to flip. They were just acquired pretty early by a bunch of aggressive guys who wanted to move from Web 1.0 to Web 2.0. And after 3.5 years, I had the opportunity to raise a fund, a $15 million fund that became one of the first macro VC funds.
And how many angel investments have you made to date since starting in 2004 with your own money, and now I guess you're on to 3 funds?
On to 3 funds, yeah. We've closed 132 investments, and we have 3 more in the pipe for closing.
And that's over, an 8-year period or so?
8.5 years.
It's a dozen a year or something to that effect, a little more?
Well, so when I was an angel and I was investing my own money, I was doing about 8 deals a year. After raising a fund, I've been doing pretty consistently 20 investments a year.
And what's your investment thesis? I mean, now that you've done 130 of these, and you've got enough time under your belt that you've seen things get totally wiped out, like this premise of, we need another search engine for blogs, because at that time, Google wasn't indexing blogs, and Google didn't really index or update the index for weeks at a time, so the concept of real-time search engines didn't exist. What is your pattern recognition now. When you get into that meeting with the entrepreneur, what are the things that immediately make you say, I got to invest in this. This is going somewhere. This has a good shot. I got to write a check right now.
So holistically, what we look at is what are the platform technology changes that a startup can actually leverage to create a major disruption of an existing market or creating a new market. And what we look for is someone who is tremendously passionate about something, a given, whether an idea that they want to go and spend the next 3, 5, 7 years of their life building and hopefully turning into a major success. And so for us, it's really the three things we look at is tremendously smart, passionate, dedicated founders, a great idea, a concept that we think is definitely different. We don't like the it's kind of Instagram with a twist, which unfortunately we hear a lot about these days. And then something which we think can be significant if all the stars align. It's tremendously challenging to execute in this environment. It's not easy to build something at scale, but if you get there, then it has to be a company which could be worth billions of dollars.
And tell me, what makes you immediately say, and I've started to have this experience now since I've started doing a little angel investing myself in the last 3 years, I cannot wait till this meeting ends. There is absolutely no way I would ever give this person $20 because I absolutely know they would burn it and it would never see any return. There's got to be some red flags that you just see a big sign go on top of somebody's head like, get me the F out of here. What are those signals?
I think it's so this is sort of a pretty exaggerated pushback that Jason is describing.
Well, you have those moments where you're like, this has got to end. This is not going anywhere.
Sure. And the challenge, I think, for us is to avoid to apply our pattern recognition, too quickly, because obviously we're trying to detect those signs that will tell us early on that this is not going to be for us. But sometimes, after 10 minutes that this is for you, and then you spend, a couple of weeks in due diligence to make sure that your initial hunch is correct. And sometimes you think that it's actually a disaster, and it's not interesting, but there is something that happens during the meeting that just captures your attention. And at the end you go like, I thought I was going to hate it, but it's actually more interesting than I thought. And so you try and avoid, especially when you're tired or in a bad mood or whatever, like today. Like by 2 p.m., I have to sort of send them an email to apologize because I was really a bit of a wreck. And so I don't think I applied my filters the right way.
Emotion can impact entrepreneurs and VCs.
We're human.
We're human,
at the end. And so the negative, sort of patterns would be someone who isn't crisp about the vision, what they want to build, the product that they want to try and put on the market, how are they going to go and acquire users, retain users, what sort of questions are they asking themselves about, the initial focus or target of the company. Talking to me about, that's a killer. Talking to me about, okay, and in 3 years we'll be bought by Google and you'll make at least 5x your investment.
Right. What does that even mean? Like you're not in control of Google?
No, that means that you're short-termist. That means that you think about, you barely started, you're already thinking about the exit. What the hell?
Yeah, you need to be focused on the product, like you're saying, this crispness of, what does that mean, crispness? Unpack that a little bit. That
means someone who basically pitches us like I had that recently. I was in Boulder for Techstars. There's a great sort of accelerator over there. And I met a team from Ubli, and the CEO, Carly, just gave me the pitch, gave me the demo of that. It's basically a plush in which you stick your iPhone 4, 5, 3, whatever, running an app that becomes the face of a character, and obviously it's focusing on the 4 to 12-year-old demographic. And the story and the way she was just presenting and the toy itself, and I had the plush in my hand sort of playing with it, was a mix of cute and super powerful. And she's just a master at selling her concept. And Carly and her husband, and a lot of investors hate husband and wife teams.
That is a red flag.
For some.
For some.
I've been very privileged to work with Kevin and Julia Hartz at
Oh,
Eventbrite.
Eventbrite is huge. Yeah.
Right. I've been working with Victoria Ransom and her fiance at Wildfire.
Yep.
On which obviously I made a lot of money. And so I have no problem whatsoever with husband and wife teams. And that team is just awesome. And so at the end of that meeting, which was supposed to be a brainstorming session where I was going to mentor them, I basically had already made the mental steps of, you guys are in a plane next week to get in front of my partner so we can just grab you and be your leads before demo day. And so that's when you just feel that there is something and it's yours.
Let's talk about a topic that we've been reading about on a lot of the tech blogs. And let's face it, the tech blogs are written by journalists who in a lot of cases have never run a company or have ever invested in a company. So they're not going to have the perspective you're going to have or I'm going to have having done it a couple of times. But there is this Series A crunch that keeps coming up. Mm-hmm. Keeps coming up. And Sarah Lacy, actually, who really knows what she's talking about, wrote a really good piece on it that was very thoughtful and extremely well researched in sort of the old journalism kind of way where she picked up the phone and talked to people, which is crazy. She talked to 10 people on the phone and asked them what they thought.
Really?
She did, yeah. It was a random act of journalism. It's crazy. But it seems to be real, does it not?
Oh, sure. And I think I had a long conversation with Sarah a couple of months ago where she said, everybody talks about it, but I can't see any evidence of the Series A crunch. And I mean, at the end of the day, it's not, you don't need to be a genius to predict 2 years ago that there was going to be a Series A crunch. You have just a set number of funds that invest at Series A stage. And their capacity might be, 100, 200, Series A's a year. The number actually doesn't really matter. Let's say 500 to be optimistic. And on the other side, you have now thousands upon thousands of companies which are seed funded by micro VCs, by traditional VCs, angels, coming out of accelerators and so on and so forth. And the capacity of the Series A world hasn't changed, hasn't increased, and if at all, it has decreased. And so you have thousands here, you have hundreds here, and therefore there's a crush. The problem is, at the same time that we try and have so many companies funded at seed, the bar that the guys at the A level are going to put on the startups is going to increase. And so what you need to prove as a Series Seed startup within 18 months of your round is just much more in terms of traction, in terms of users, in terms of retention, in terms of whatever your KPI is. It's just harder. And so
KPI for the people who don't know.
Essentially the metric that is going to
key
determine
performance.
Key performance indicator, yeah. That is going to determine whether you're successful or not. So you can't whine about it. You can just live with it. Understand that the bar is higher.
But we're not seeing tons of these angel companies wipe out yet.
Oh, sure.
But they're sort of silently wiping out. Yeah. What exactly is happening? We see obviously acquihires. There's some that are just acquihires.
Acquihires happen, and you always celebrate success. You don't go all out saying, I just bombed. And so people by definition will do it very quietly. So yes, the lucky ones are acquired, others just disappear. And I recently had a conversation with the VP of Corp Dev of Salesforce, who told me that they were just bombarded by people who were trying to get a soft landing for their companies. And it's at the end of the day, it's very Darwinian, right? Either you succeed and you go through a Series A, or you don't and you crash and burn. So
not that big of a deal.
Is
it better to have a Series A crunch than to have a drought of angel investors? If you had to pick one.
To me, angel investors, the flow of money that comes at the angel side is either personal wealth, and there's a lot of people who've made a lot of money at Facebook, Twitter, and the few sort of IPOs that have happened recently, even Google. The Googlers are pretty active. So there's no end to this one, because even if someone loses, a couple hundred Ks and they're worth a few tens of millions, it doesn't really matter. What what is actually not, expensible is the money that is available at the A, because it's controlled by the limited partners, and those guys are not really sort of interested in putting more money in VC. So there's actually not really a notion of one or the other. What's going to happen is the crunch at A is going to remain. At some point, people will either decide not to go and be angel investors anymore because it's not fun and they're losing money, and that's going to happen.
That's starting to
some.
happen already.
Absolutely.
Yeah.
Or they will keep on pouring, cash into startups because it's cool. And that's the one difference between you and I starting to invest in 2004, 2005, 2006, where we did it because we really wanted to support entrepreneurs. And now where, you invest in a startup because it's as cool as having an expensive car.
That is part of the vibe. But
It's true.
And entrepreneurs benefit from it. But because the standard's gone up, I think this means that the people who do get that A round, these are going to be pretty darn strong companies, which means it's good for the ecosystem in a way.
Which means it's good for the only issue in all this is the fact that you have so many people who can be entrepreneurs, and that's great because everyone gets a shot, so that's really positive. That means that we're really short of talent, and it's hard to really hire top people in companies that are succeeding. And so the bench for even strong startups isn't as strong as they used to be.
So, translation, some of the people starting companies might not actually, that may not be their best role in the ecosystem. Their best role might be to be the second or third or fourth person at another startup, and that startup will collectively be stronger.
So what would have happened 5 years ago is they would have been number 3, number 4, number 5 of a strong startup. They would have learned the entrepreneurial, sort of job on the job in that startup, and then whatever they do next would have been actually interesting because they would have been trained. Instead, they just go ahead and start by themselves, which, to be honest, some actually have been very, very successful. I remember, Aaron Levy at Box. You remember when he arrived in the Valley? He was like 20 or 21, 20, because he couldn't drink, I remember. And it was sort of amazing, this vision he had for a 20-year-old with Box. And he's basically executed on that. And he's now, very unstoppable and very funny. Like, if you follow him on Twitter, he's excellent.
Oh, he's hysterical on Twitter.
And he's built a very strong company. So, nothing should have prevented him from getting a shot at being an entrepreneur, which is why it's always positive that everyone gets a shot. The problem is that the consequence for the ecosystem, aren't always sort of super positive.
Let's talk about the recent announcement at Y Combinator that they're pulling back the number of companies. They had over 80 at the previous class.
82.
And you seem like a little bit, it was a little bit overwhelming as an angel investor to process. Yeah,
Sure.
I mean, I think everybody's felt that
You
way.
were brain dead by 50. You were about to shoot yourself by 75, and the last 7 were just, whatever.
Yeah, nobody can remember. And I guess Paul took that to heart, really seeing if he could, and he said in his post, we try to push the envelope, pulled back, and then also pulled back a little bit on the
funding, yeah.
Yeah, what people were calling in the industry free money. Did you agree with the sort of Yuri Milner, and I know obviously I'm not casting aspersions on Yuri Milner, nor would I ever do that to anybody who is especially Russian. You never know.
Why did you say that?
I don't want to get whacked here or anything, but no. In all seriousness, it seemed like a very generous thing to do to invest in every single company coming out of Y Combinator. It also seemed very savvy, but did it also? How did you perceive that as an angel investor who spends all this time with startups trying to make a decision that somebody with a bigger bankroll than you just said, "I'll take everything"? What was your emotional reaction when you woke up that day and said, "I'm going to the event with a process to try to decide," and another person is just saying, "I don't even have to go to the event. I just take everything"?
Well, and remember that Yuri wasn't the first to actually put this together.
Right.
It came originally from SV Angel and Ron Conway, who
Right.
obviously we have tremendous sort of respect for.
Sure.
But it's true that we went like WTF. I think I can't say like what the...
You could say what the, sure,
Okay.
you could say.
Okay, so what the
I think so.
And
It's the internet.
because, I don't know, I thought I was told avoid, the F
It costs you $10 in the swear jar. That's okay.
I knew I was going to get caught. And so the whole notion of funding by default all those companies was sort of strange. At the same time, if you look at the performance of YC as an investment, it's actually been really, really good. And the guys who invested in YC are going to make, bank.
Sequoia was famously
Sequoia
was famously the secret money behind Y Combinator in the early days.
It wasn't secret. It was
it wasn't
above board.
talked about really.
No,
Did people know about it?
Well, I knew about it.
You knew about it. Did people here know that Sequoia back to the early days?
So there was no.
I see a lot of no's. I see some yeses.
There was no surprise, at least to us in the ecosystem. Yeah. But the point is, it's a different sort of investment strategy. We pay a great deal of attention to selecting, one, maybe two companies per batch, go through the process, do reference checks, negotiate, the terms, and the expectations being YC is always there, and we always bring them there, and sometimes it works, sometimes it doesn't. But we just want to have what we think the best startup in the batch in the portfolio, and others say, look, on average, YC companies just kill it, and if we have a shot by being an investor to sort of start monitoring the next Dropbox or the next, Airbnb, then we'll be able to just pile in as soon as we see the inflection point. It's just a different sort of investment strategy. I'm not saying that it's bad. I would certainly not do that, and if I did that, my own sort of investors would shoot me, because that's not what I'm paid for. I'm paid for to select, the potential next Dropbox or Airbnb in the batch. The issue, though, as more and more cash was made available to YC companies, and they ended up with 150 grand, free money, no questions asked, is that you started having startups that were just, 2 people and lasting for a year or a year and a half, iterating on their ideas, and therefore a bunch of YC companies became like not really dormant, not really doing anything, and I don't think it's good for
zombie
them.
Companies, people would call them.
Yeah, zombie companies with 150 grand in the bank, yeah.
Yeah, going sideways. So when you look at the space today, where are we at? Because, we've had this big, grand debate going on. Is there a bubble or is there not? The stock market is valuing companies, technology companies, extremely low, as Mark Andreessen correctly pointed out. 8 times, 10 times revenue. It's Google and Apple. Everything's being, valued so low on a multiple. Mm-hmm. It seems like the angel bubble is over. It seems like, will you disagree? Or
I'm not sure.
The valuation bubble maybe is coming. I heard valuations, and I seem to see
valuations are coming down a little bit, but I still have people sort of asking for outrageous, numbers right from the get-go. I still see startups starting their fundraising and then a few weeks later wrapping up their fundraising. So I haven't seen, a dampening of the enthusiasm at the angel stage.
So, but maybe it's not increasing. But it's not going down tremendously, it's not increasing. When you started angel investing, those first couple of companies, what were the valuations like?
Typically, they were in the 2 to 3 pre range.
$2 to $3 million pre. And the last, handful of deals you've done are in the, what did it peak out at?
So 5, 6, 7, with a couple of outliers above 10. But for companies which had made, a lot more progress, or with repeat founders. Where you look at the track record of those guys and you almost sort of give them a check and then ask, what did you do again? So
if a Mark Pincus shows up or an Evan Williams shows up, you're not going to particularly care about the valuation. You're going to care about getting into the deal.
Potentially, if you believe that they can actually do it again, yeah. And so for us, I would say the range right now that we expect when we price is between 4 and 6. And if we get into 4 and 6, it's pretty much the expected range. Sometimes we have to show flexibility, and so we've done 7, 8 pre, when we felt we needed to.
Big controversy early on with convertible notes. They're all going to come due in 2 years. It's going to cause all this chaos. And Ron Conway was originally sort of, I think, against them. Other people were sort of came out publicly. Fred Wilson, I think. People seem to change their mind about that. Do you care either way about if it's a price round or not? And did we ever see these sort of chickens come home to roost with the convertible notes, having to be negotiated, or does it not matter because if a company gets to that point and they can't raise money after whatever it is, 2 or 3 years, you're not just going to wind it down anyway?
Yeah, I think from our standpoint, we've always been clear that we would never, ever, ever, ever invest in a convertible note that wasn't capped. So by definition, I will never invest not knowing the valuation at which I would put in my money. And so for us, a convert note with a cap or an equity round is sort of the same. We always prefer to put money in an equity round because that creates a board, that creates a structure. There's a set of documents that define investor rights, and we make sure that the company, I mean, when we do a round, we always go through more due diligence on the legal side. We make sure that the 83B elections have been done, and the company is just better off. And to be honest, with Series C documents, it's $5,000 to do a note, it's 10, 12 grand to do a round, so might as well do a round.
And is there a diffusion of responsibility that happens when there's a convertible note?
Yeah, because no one, I mean, not when we invest, because we're always the largest, second largest investor, because of the average investment for us is like in the 500K. But there is a risk when you put just a simple note together that no one is really the lead. The company decides the valuation, and everyone goes like, yeah, it's all right, and no one feels responsible for the support of the company. And so when the hits the fan, which happens all the time, there's no one to really sort of pick up the pieces and then say, okay, this is how we're going to solve the situation. And for some reason, when you put a round together, this doesn't happen as much. What you want, though, as entrepreneurs, is make sure that you don't have, let's say you raise $1.2 million, you don't have 12 people at 100K or 24 at 50K. You want 1 or 2 players, investors at 3, 4, 500 each, so that those guys are really motivated to help you. Because money, yeah, it's sort of necessary, but it's really not the value that we investors will deliver to you, or hopefully will do much more for you.
And what do you see your value proposition, not just your firm, but you yourself, Jeff? What do you think that you do particularly well as an investor?
I think over the years, you learn about patterns, both of success and failure, and sometimes it's kind of an interesting discussion with a founder to say, I've been down this road before, and this is what's going to happen, so avoid making that mistakes. Unfortunately, it feels like sometimes founders have to make that mistake themselves to realize that we were right. It's a bit like when children get told by their parents, don't do this, and they do it anyway. I've done that. What we do particularly well, I think it's supporting the companies on the product, marketing, biz dev, sort of scale side, early scale. I think that we're pretty good at helping the companies over the first 18 to 24 months, navigating the the launch, navigating the early scale, getting the thresholds, the hurdles sort of figured out, and then raising their Series A. After that, once we have gotten a great investor involved, we'll step back. We'll still be involved. We'll still help. We'll still support. But the keys will be in the hands of the Series A VC, and being able to replicate that and still be super helpful to companies when we have 75 active portfolio companies requires a bit of a discipline.
You invested in Mint. Was that before or after they won the first TechCrunch 40?
That was before. That was a year before.
Yeah.
So I committed to Aaron in July of 2006. We closed the round in September, I think, and then we were on stage at TechCrunch 40 at that time.
40, yes.
40, and you were there because I was on the VC panel announcing my fund, and I was wearing a Mint T-shirt, which was sort of, hey, make Mint win, and Mint actually won.
Yeah, that was actually, Mint.
And I remember him saying, "What the f is this shirt?"
Well, actually, in those days, Mike and I would write down on a piece of paper when we were partners on the conference who our number 1 was and who our number 2 was. And then we would flip them over at the same time. And that year, we both had Mint number 1. We were number 2. That's how we decided the winner, because we didn't even remember that we had to pick a winner. What was it about Aaron, though, that you fell in love with and that you want to invest? And I'm going to guess that's your best investment ever, or amongst the top 2 or 3?
It's definitely one of the best. It's not the best. So Aaron was a solo founder, and solo founder is always tricky because it's a very lonely journey to build a startup on your own and not have someone to chat about, to share ideas and emotions and everything. But Aaron was exceptionally disciplined and had essentially spent a year working, 18 hours a day and building the first version of Mint, and he just had this very crisp vision about, the fact that no one, Microsoft at that time still had money, Microsoft money, or Intuit with Quicken were not delivering the kind of experience that a modern personal finance website should deliver, and that's what Mint was promised to deliver. And I thought it was extremely compelling, and I had to just write a check. It was sort of almost so obvious to me by the end that I was going to do it that I didn't commit on the spot, but very shortly thereafter.
And what was the return like on that one? I mean, that sold for $300 or $400 million.
No, it was 170.
Only 170.
So it was,
I'm sorry, only 170.
Well, because we were angels and invested very, very early at a low
valuation. So you were in at a $3 or $4 million valuation. So
you said that I didn't, but yeah.
Okay, so I'm going to guess you said before $2 or $3, $4 million was the valuation at that time.
It was
the average
17, 18x.
I mean, that's got to be incredible as an angel investor when you have one of those big wins. It just makes you what? When you have a win like that, does it just make you want to go out and invest in 10 more companies?
No, I think that just validates that every now and then it works, and so that's why we continue. It makes the wife happy.
Yeah.
Because for the first 3.5 years, we put in almost $1 million of our own money in a bunch of startups, and so at some point you have to, get the money to come back. Otherwise, you have a bit of explaining to do. Luckily, A, my wife is exceptional. B, the Truvio deal was so good that it returned a lot of the money that we had committed but not even spent before we actually had to spend it. So it was actually a very comfortable situation.
And what is your expectation in terms of the number of outcomes you're going to have per 10 investments? Do you have a thesis about that, or?
So if I look historically, so the traditional VC expectation is that you're going to lose 30% of your investments. I think we're closer to 20, but not everything that can screw up has screwed up yet, in the sense that we still have a young portfolio skewed actually to the early stage. We have a number of companies which have gone through their Series A, that's the good news, but there's also a Series B crunch. No one talks about that one, but it's actually there. And so we want to see those companies, sort of go through their early funding sort of trajectory, and then figure out how big the outcome can be. And so that's where I'm super stoked about, Eventbrite, Fitbit is just absolutely freaking crushing it. A company like Gunip is also sort of making enormous progress.
Gunip was that Techstars too? Is that a bit of Boulder?
Gunip is actually in Boulder, but it wasn't the Techstars.
SendGrid is
SendGrid
is the most succcessful of all
Techstars, yes.
From what I understand, yeah.
So all those guys are in the portfolio, and so we'll see, which one is the first to go public, and which ones actually will be a great outcome, but it's still, years away. So you have to be very patient.
Let me ask you a question that I've just started to face, early in my angel investing career, which is a company's really not doing well, and they want to be introduced to Mark Cuban or to Roelof Botha at Sequoia or whoever it is, somebody at Excel or Benchmark, and some very important contact, but you no longer think that they're going to make it. This must have happened to you.
Sure.
How do you handle that? I don't know the answer.
Well, the answer is no.
Just no?
You explain. No, you.
Okay, so please explain it to me. Hey, I'm Jason.
You say no, you snap.
My company's failing, and
So
explain to me.
Essentially, at least we, don't wait for companies to start, crashing and burning before we have a conversation. So we're in regular, sort of contact with our companies. We help them figure out what the hurdles are, what the issues are in execution, and so on and so forth. And we sort of know. And unfortunately, whenever we feel that we have the early signs of failure, we rarely are wrong. And so at some point, we're going to have a discussion around, look, this isn't working. Based on all the data points we have, you're just not going to be able to raise a Series A. So as opposed to trying to raise a Series A, let's just go and find you guys a landing spot, acquihire, acquisition, whatever. Or in some cases, just shut down the company and you guys are home free to do whatever you want. But the promise, the commitment I've made to my peers in the VC world which is pretty simple. I will never put in front of you a company that I don't believe has a shot at succeeding. Sometimes they might not like the investments, they might not, figure out that this is a big opportunity, but never will I lose your time with something that isn't worth it. And so, because 132 investment, 30-ish, sort of disappearing, some being acquired early means that we need to find 80 investors for 80 companies Series A's. And unfortunately,
how much of your time does that take? How much of that is your job? That following on funding and getting those companies over to the A to the B? Depending on,
it ebbs and flows, but I would say between 10 and 20% of my time is spent on working on financing companies. We've just gone through seven sort of Series and Bs over the past quarter.
One of the things I'm seeing in the market is acquihires, where the founders get really nice chunks of change from Mark Zuckerberg or somebody.
Some do, not all.
Nice chunks of stock options, let's say. But the investors get hosed. And as one investor said to me, Zuckerberg said explicitly, "Who cares about your founders? I'll just get you a bunch of shares in Facebook. Don't worry about your investors, not founders." Told the founders this, and they wound up not doing that. But the story was told to me by one of your peers. What do you think? And you must have faced this sort of acquihire where you get hosed, but the founders do really well. How do you reconcile that? Because you also have your LPs now that you have to service.
And so founders also have a conscience, and so what we have done, more often than not, is let's say that there is actually value in the company, and yes, the founders and the employees will get stock options and so on and so forth. I've actually seen a lot of our founders fighting for us to get our fair share, which is either respect the cap table and the waterfall, which basically defines how the money gets split, or make sure that we can at least get money back. The challenge, though, is that the acquihire considerations have dropped like a stone since 3-4 years ago. You could sell a company to Twitter or Facebook or Groupon and actually make a lot of money for sort of what was a failed company. Right now is just a few tens of thousands per developer in options, and investors pretty much get nothing. At the end of the day, it's our responsibility to try and soft land our companies. If an acquirer has a pattern of always screwing us, then we'll try and go to them, the last. But
so they earn a reputation of, hey, maybe I'll go to the person who in the corporate development office is going to be reasonable first. So there's a little bit of a self-correcting mechanism going on.
We sort of exchange tips all the time. I mean, a lot of the micro VCs started as angels, and all my peers, when there was like 10, 12, 15 of us investing, and that's how all these people sort of became the super angels, so-called. Yeah. Even though we all have funds, we never compete because we have our own sort of investment strategies. We try and sort of work together, and so whenever we got pretty badly screwed, either by a VC in the next round or by an acquirer, a lot of people know about it.
Reputation matters.
Sure.
What's the craziest thing you've seen a VC do, bad behavior-wise? You don't have to mention the VC's name, but you've seen a lot of bad behavior. People hear about it, and we'll go to entrepreneurs next. But what's the worst trait of VCs that you've seen and that really entrepreneurs should be wary of?
VCs trying to win a deal at all costs, throwing crazy valuations and really doing everything and anything they can to win a deal, getting the deal, and then backing off of it.
Like just not being engaged, not helpful.
Not fulfilling, essentially signing the term sheet and then saying, we won't actually invest.
Wow.
So do everything to get the deal, be super aggressive.
Actually happened.
Oh, yeah.
That's extremely rare, though, that somebody would send a term sheet that did not close.
That should be very rare, and whoever did that to me should actually, have a horrible reputation. The problem is that they actually do that. I heard afterwards that the guys who did to me in the portfolio actually had a pattern of doing that, doing everything to win the deal, and then, backtracking out of their commitment. But because there aren't that many firms doing Series A's, and otherwise they're a good investor, their reputation hasn't taken a hit yet. And obviously
it can take a little while.
And no one goes public with it, obviously.
But there is a lot more transparency now than there was when you started.
Oh, sure.
And that's helpful.
That's helpful. I mean, I think
VCs behave better, right? Because of it?
I do think so, yes, because there are now watchdogs of sorts that will call them out, and at some point that story is going to come out, and that is going to be sort of interesting. As we say in French, revenge is a dish that gets eaten cold.
Very nice.
So we'll see. But when I started, there was Fred, Brad, David Hornick sort of blogging, and the tens of VC bloggers that followed in their footsteps, me included, I think helped really removing this aura of mysticism around VC terms and VC behavior. So I think that VCs now have to behave much more, what you would expect them essentially to do. But I've still witnessed pretty damaging behavior from them, because then you have to go back to the other investors you said no to and say, sorry guys, we said no, but actually we'll take the term sheet back. And if it's a bit lower the price and the terms are harsher, we don't have a choice, so go for it.
I'm going to take your questions in a minute. So if you have a question, do we have a microphone or we're not? We do have a microphone. So you just raise your hand, and then I guess Karen will run over there. And please don't feel the need to plug your company or sell your legal services and put a special ad in there. I just always give that disclaimer, because there's always that guy who does it. The guy who's like, hey, Jeff, staffing is so important. And my company, Acme Recruiting, does an amazing job with flat rate. What do you think of flat rate fees for recruiters? I mean, it happens every time, right? So I have this little preemptive thing. Don't plug your company, but you can say your company's name and have a great question ready to go. Let's do some word association with your peers, Dave McClure. Mm-hmm. What do you think? You tell me first. I'm going to say the day is super angel. You tell me what you think of them. Dave McClure.
Well, I mean, first and foremost, Dave has been, a very good friend of mine for a long, long time, and I respect that he's basically different, going out there with a completely different strategy, doing, 200 investments a year when I do 20, and investing all over the world when I only invest in Silicon Valley, New York, Boulder, and Southern California. And, at the end of the day, performance and returns will define who is right and who is wrong. But certainly he's helped tremendously develop entrepreneurship worldwide, and I respect him for that.
Chris Sacca.
Sacca is awesome. And he's very, very successful. If you look at, I don't know how he does that, to be honest, but he's always done a few sort of off-the-wall kind of strange investments, and they end up sort of paying off. Obviously, he's killed it on Twitter, and he has this approach which is pretty unique. So I respect him as well.
Naval.
Angelist, Naval, I'm not going to say that much bad on my friends, but just FYI. Naval, really gifted investor who's done really well also on Twitter. And others. And AngelList is a service to the industry, which is really important. Mike
Arrington.
I haven't seen much of Mike. The Crunch Fund is a bit like...
or MG Siegler.
Yeah, I've seen MG last week. They're out there building a very large portfolio of investments at different stages. Once again, we'll see how they do. We're sort of focused on being the first money in. Investing in a Series C or Series D at hundreds of millions of valuation doesn't mean much for us. They're doing it. We'll see.
Okay, questions from the audience. Okay, Kieran, let's run one over. Wow, lots of questions. Good. Okay, keep it nice and succinct.
Sure. Hi, my name is Rommel Fox. My corporation is whomentors.com Incorporated. Jeff, you mentioned that the bench for entrepreneurial talent isn't that deep. Have you ever found the occasion to invite foreign nationals to come to the Silicon Valley to create a company?
The issue is always sort of a visa issue. So to us, as long as you're local, it doesn't matter whether you speak English with a funny accent. And therefore, the definition of a local company is actually pretty broad. The problem is we never fund a company to move it. I mean, we've done that a couple of times, but it's always sort of a big issue. And unfortunately, the US isn't as forthcoming with foreign entrepreneurs as it should be, because we should essentially roll the visas and everything that anyone who's French or from the UK or from anywhere wants to build a startup here, they should get a visa immediately.
Why hasn't Obama, after coming to the Valley to raise tons and tons of money,
I know, right?
And just absolutely dropped the ball on this? I mean, Chris Sacca and Shervin, those guys raised millions of dollars from rich VCs and founders here in the Valley. Everybody's got a picture of themselves with Obama, who sold a company. It's ridiculous. Path is just like one big Obama stream before the election, and he can't figure out our most pressing issue. He's done nothing.
So here's the issue. We've been working on the entrepreneur visa for about 3.5 years now, and I think that for once it is an issue that everyone agrees needs fixing. Both Republican and the other side is fine. They want to support it. They have supported it. The problem is that there is always someone who tries to sort of tweak the law or the proposal at the very last minute. And so the last time we thought we had a shot, but what someone did is take the 55 sort of minority visas and replace them with entrepreneur visas, and that is what Obama said, there's no way I'm going to remove those visas and need them, as opposed to just adding 55,000 visas. The other issue is we have the entrepreneurship visa part of the more comprehensive immigration reform, which deals with the 10 million people who don't have legal papers. And so no one wants to just take our little issue and just pass it. It's not that, it's not so much of a big deal. And the Brits, to their credit, heard about the visa concept, looked at it, studied it, and within 6 months had it. Yeah, pretty much. But they put it in place, and they have it. And so,
so now founders can go to London and just get going.
Yeah. And London has been extremely forthcoming, with European entrepreneurs and I guess any entrepreneurs. And it's actually a really good place to start a company in Europe. It's kind of expensive, but at least they're really trying hard to fund, all the infrastructure to make London a real sort of entrepreneur,
Well, Obama did, along with both sides of the aisle, get the startup bill passed, which does crowdfunding, and so that's a good thing. You would never invest in a startup in France, would you? That's a no, by the way. When you have a pause for 30 seconds, I don't need to hear the answer. Look, Loic left, and look at the tremendous success which you invested in Seismic, and he just sold LeWeb. Loic has had tremendous success, and he's only been here for 5 years.
Mm-hmm. No, I think
you've had tremendous success,
and we've been here for 12 years.
Yeah.
The thing is,
you could never do that in France.
If you look, Xavier Niel was free, Jacques-Antoine Grandjean with Vente Privée. There have been, a few successful internet
stories.
Vente Privée
has been amazing, yeah.
But yes, it's true that I haven't invested in France for a long, long time, and it's very challenging. I was chatting with them at LeWeb last week. We were sort of welcomed by the Prime Minister, who did a speech about what he was doing for the French startups or whatever, and then suddenly he turns to Loic and I and go, and those in Silicon Valley should consider coming back. And then we have like 100 people watching us. Really?
The press, Le Monde. Okay, let's do another question.
So Correlation Ventures has taken away the human element of venture investing by being the data-driven, aka Moneyball of venture. What are your thoughts on that model, and is there going to be more shifting towards
I haven't even heard of this. Correlation Ventures? I haven't heard of this.
Yeah. Once again, we'll see in 10 years how well they do or don't. I don't believe in multiple in early stage investing. So, and we try and sort of collect a lot of data and so on and so forth, but we can never weight something more than another. So having this big spreadsheet which tells you whether to invest or not, I don't know how to do that. Those guys are smart. They came to see me, and I said, look, if you're successful, you'll prove me wrong.
Time will tell.
It's really sort of this is an art. It's a craft. It's not something you can industrialize.
One of the factors I've heard from many VCs, entrepreneurs with immigrant parents. You see a trend there? Is it, if the person comes from immigrant parents, they work harder, they want success more, they're more driven, more likely to invest in that kind of person, or more interested in them? You see a pattern? That's sort of old wisdom, right?
Yeah, I think it's old wisdom. It's sort of understanding the value of work and dedication, but I don't think this is sort of a major trade that we're looking at. So I think there is a potential correlation in the entrepreneurs we've backed, but we never sort of think about that.
Going in, it's not like a thesis or anything. Next question. Here we go.
Hi, Michael from Epilogger. So I want to kind of ask a little more about this so-called Series A crunch, and I think, so I'll give you my opinion and ask yours, is I've seen other VCs speak about it. I've read Fred's blog, I've read the thing recently from Read Write Web, and I get the feeling that it's nothing new. I mean, I don't think VCs, good ones like yourself, will invest in crappy startups. I think that it's more of there's so many startups now. I went to a few parties around town, and there's just like tons and tons and tons, and a lot of them do very frivolous kind of stuff, to be honest, like some silly, it's cool for like 2 seconds, then you kind of think forward, and it's not that cool after all. So do you think it's more of a self-fulfilling prophecy that's just more like the media is saying, like people just trying to pop the bubble desperately, or do you really think there's a crunch that's more pronounced now because of a lack of, fully engaged funds, or just because it's a matter of throughput? For example, so like I said, here is just so many startups that it makes sense. But if you come from like Canada, where I'm from, there's less startups, but they tend to be a little more careful about what they're selling.
You said before the benchmark has gone up.
Yeah, the benchmark has gone up because there are so many companies which will be funded, and there are a lot of really good companies coming up for funding, and so only the best get funded. So I agree with you, it's nothing new. It's just that the funnel that comes out of the seed world is much bigger. It's like
so 2x,
3x, 4x.
The same number of people will get funded, but more people will not get funded.
Yes.
And people who would have previously made the cut 5 years ago will not make the cut today for the Series A.
That is true. And so that means that you will see alternate sources of Series A's develop, whether, corporates will start doing Series A's. You will start seeing...
Like Google Ventures?
Yeah, the Google Ventures is kind of a real VC. So, some media companies or some really surprising companies will sort of do Series A's, whereas typically we're coming in, to them, maybe Series B, Series C's for
strategics.
So strategics, yeah. You will see sometimes a gang of micro VCs putting together a Series A, and we've done one of those, and we're actually pretty excited by the company.
A syndicate.
Yeah. So
can you say which company that is? Or is it too soon to
we haven't announced. It's actually in Southern California, but we haven't announced it yet.
Wow. So
I actually wonder if you're an investor.
Anyway. It's if the situation were to exist, and you were syndicating a bunch of folks together, that would be like 10 VCs at $250 each, or 12 VCs at...
There will be 3-4 macro VCs at $850 to $1 million. So it's a pretty substantial commitment for us. And the idea is it's, seed plus A in one go. So from a commitment standpoint. So we end up with, $850 in the company, as if we had done a $500K investment at the seed level and then a $350 investment at DA. So, but that will be at the margin. So you won't see a way to increase in a major way the Series A capacity. That might sort of be 10% or whatever.
Some people could actually try to make their companies profitable.
Sure.
Too.
And, it's...
I mean, it could change the philosophy of, instead of trying to get scale, trying to get customers earlier in the process.
Yeah, and it's always an issue of if you can grow as fast as... one of the questions we always ask is, what is capital allowing you to do except paying for engineers and so on and so forth? And if the answer is I'm growing as fast as I can, I'm acquiring customers as fast as I can, you don't need money. And so growing the old-fashioned way, which is going to profitability and then growing on cash flows, it's not really sort of the way Silicon Valley is typically building startups, but it's a great one. Look at GitHub. They raised their first round was 100 mil at like a crazy $700 or $800 million valuation.
Well done. Next question.
Hi, David Chang from VendorStack. Jeff, do you ever make investments in competitive spaces to your existing portfolio, and how do you feel about people who do?
Great question, by the way.
So let me share. Let me make sure I understand. So I have a company in a space, and then someone sort of pings me about investment in the same space.
You have SendGrid, and somebody comes with SendGrid, the disruptive product that's going to disrupt the hell out of SendGrid. What do?
I will immediately point to the fact that I'm an investor in SendGrid, and unfortunately I won't be able to proceed with a meeting or even considering the investment. And we have a pretty wide definition of competition, meaning if it's clearly competition, it's not possible. But even if it's an overlap, we will sort of politely decline because we know that a SendGrid will go much beyond what they do today because they have to scale and become a bigger company. So we'll create some kind of a white space around all our companies and make sure that no one touches that white space.
What happens if one company in the portfolio pivots, which happened to Mark Andreessen with Instagram and another photo app?
Yep.
What if another one pivots and then all of a sudden you have a conflict? What do you do?
It actually happened to us. Two companies doing two things completely different, and they both pivot into the same space. And you go like, and what we ended up doing is agreeing with the second CEO who pivoted into the space of the existing company that we wouldn't work with him for the period of time of the pivot. And it was a completely fucked up situation because those two CEOs are really good friends of mine, and I had to say to the second one because he was just pivoting into what the other
was second to the idea.
He was second to the idea, and we sort of agreed that I couldn't work with him on that. So for 9 months, basically, I didn't hear from him because he was trying to compete with my other company.
Wow, crazy. Let's take another question. These are good questions, by the way. I have a smart audience.
So the first question is, would you tell your seed startups the metrics for Series A? Or does that really govern your seed funding thesis?
No, because at the end of the day, so when we invest, we have to ask ourselves now, what are the hurdles that are going to be in front of this company? What do they need to clear to be successful at a Series A 18 months from now? And we have to ask ourselves if we think they have a shot at it. The problem is that we don't know. We have I think we are much in a better place than entrepreneurs to have an educated guess, but we don't know what the hurdle is going to be because it's often once you're past the Series A that you see what the hurdle was, and the hurdle is sort of is a moving target because unfortunately all opportunities are not evaluated in isolation. It depends on what else you're looking at. And I had one of my companies, which I'm very excited about and I think has a real shot at building a big company, got turned down by a friend of mine who said, look, they're top 3 in the funnel. The bad news is that we'll be funding only the number 1. And so depending on the timing at which you reach a given firm, you might be, number 1 or number 2 or number 3 in the funnel. And that, you can't do much about it.
Let's take another question.
The other question that I have, there's this new talk going on enterprise software. And some of us who are older kind of like enterprise. However, we cannot no longer go to Series A because what they are looking for is a little bit higher. And for seed, we are not doing some little Web 2.0 conversion, but you need a little bit more money and a much more educated VC. And what do you think of the shift in the market to that more enterprise software?
So we've spent a lot, we've always done B2B investments. We're spending more time looking at a lot of consumerized IT. So consumerized IT actually has some of the traits you pointed out, which is you're building a real product that is going to be solving an enterprise, sort of problem. What you need to figure out is how you validate the ability to create demand, how you're going to acquire customers, and whether there's any tricks that you learned on the consumer side that can be replicated on the enterprise side. And we've seen a few of those, and we've made quite a few investments this year in that.
It's like ground up IT. It's like from the bottom up. The people's IT, Dropbox, Box, Yammer, starts with somebody in a department says, I need a solution, I used it, and then the IT department finds out about later that 17 different people in the company are using it.
And it's all about cloud-based sort of delivery. It's all about bring your own device, so you have it on your phone and so on and so forth. So we just have a set of infrastructure today available to us that enables consumerized IT in a way that was just not feasible 5 years ago. And I'm actually an enterprise software guy. I spent 12 years of my life building enterprise software. And it was just horrible to see those sales cycle and having to convince CIOs, and that's what we're trying to avoid in terms of what we fund in that space.
Let's take another question.
Hey Jeff, it's Alex Marino from Tennis Round. Switching gears a little bit to consumer internet startups, what do you prefer to invest in, traction or revenue?
On the consumer side, the question is traction or revenue, or something else?
So we'll want to understand essentially how the traction has been generated and where the revenue is coming from, and whether this is something which is truly something you can retain. We've seen over the past 6 months a number of startups just shoot through the roof in terms of numbers because they had figured out a way to leverage Facebook or Twitter or whatever to get pretty viral with sometimes very aggressive techniques, and they raised their round, and then a few weeks later they dropped. And they drop sometimes to 95% of the original traffic, which hurts. It's worse than Groupon. And so we really want to understand whether there is organic retention, something that basically gets users back every day, several times a day, or every week, several times a week, just because they need the application, they want to use it. So I would say traction is typically what we look at. If there is revenue, it means that someone has figured out both, the traction and the revenue. But in the consumer world, it depends too much. E-commerce, it will be most likely revenue. If it's traditional social media kind of thing, it will likely be traction.
1,000 people paying $10 for an app, or 1 million people downloading it for free. Which one do you want to take the meeting with?
Typically the million.
You go for the million.
Yep.
100,000 downloads, 1,000 people paying $10. Which one do you want to take the meeting with? You can only take the meeting with one.
Well, I would take both.
No, I think this is a test. Would you only take it from one?
It depends on where.
But now you're thinking about it.
Yeah, it depends on where they. Paying for downloads is easy. Getting organic downloads is hard. So if someone can get the downloads, get the activation loops, and then 2 weeks later still has 60 or 70% retention on those users and the cohorts look good, we'll take the meeting.
Right. And in other words, he's got a well thought out process and he's going to drill down and do due diligence. Let's take 2 more questions and then drink.
Hey, Jeff.
Go ahead.
So curious, you mentioned before the conversation you sometimes have to have with entrepreneurs about things are just not working. We need to consider an acquihire or do something else. Shut it down, go do whatever else you want to go do. Tell me about those conversations and how are those like, and what have you learned over the years in having those conversations? How do you make those softer landings?
So, and hey Sunil, it's
a great question.
It's a great question, and it never. I can't think of that conversation happening as a shock to the CEO, meaning that I know it's not working because he knows it's not working. And so the question is more, okay, we've tried everything we know, we've changed the product, we've looked at, the data, we've, evolved a few things, maybe we've changed a couple of developers and so on and so forth, but at the end of the day, it's just not taking off because it's not as good an idea as we thought. And, once we've gone through all the things that we know, might have worked, then we'll just say, look, clearly the bar was here for you at the very least, and we're here. There's just no way this is going to work. So let's figure out how to end this. And sometimes it will just be a simple, look, dude, we still have 6 months of cash left. So by definition, you can still iterate and try new things. But if you feel that this is sort of done, feel free to say so, because whenever you raise money from an investor, there is this sort of commitment to us that you will bust your ass and work super hard to try and turn this into a success. But if we see that it's just not working, we'll try and just
You want to free the
stop
person.
there.
You don't want to see somebody suffer through something you know is not going to
Sure.
work.
And so-
You'd rather get the 20 cents back on the dollar and put it towards the next deal.
It's not even the 20 cents on the dollar that matters.
Or the person moving on.
Yes, I think it's more, hey, and I've had that conversation very recently with an entrepreneur I've been working with for 2 years, and I really love those two guys, the CEO and the co-founder, who is the CTO. They're awesome, and I will likely sort of look very positively at what they do next. But we tried something, didn't work. They pivoted into something which started to get traction, but we haven't proven yet that this is potentially going to yield a big company. I've already given them an extension, a bridge, and I never do that twice. And so I said, look, what do you want to do? We can try to cobble something together and find someone to lead another bridge. But if you're not into it, if you're not convinced this is going to work and build a big company, I'd rather sort of let you go free. And, we'll lose 600-700K, which sucks. But at the end of the day, that's our job. It's trying super hard for 2 years, and it's just not there. And I think that our ability to say, look, if it's not working, just let it go, and we'll help you, do it as properly and cleanly as possible, because there's nothing worse than a hard landing where you have creditors and potential lawsuits or whatever. So that's pretty horrible. We'll definitely be on the front of that.
And if you're not having companies completely wipe out, you're not really investing in the right companies, are you? I mean, you need companies. You said early on, you're looking for disruptive things. You're looking for things that change the world. If something's going to try to change the world, it's got a good chance that rocket could go off course and just,
Oh, sure. I mean, that's if you're not ready to fail, you will never sort of do big things. And that's true on both sides. And so every time we invest, we know we could potentially get wiped out, and our cost of failure, which is basically how much we lose when a company just blows up, is now $500,000. And recently we had to write off a $800K investment. I hate it, but I have two co-founders who've spent 2 years trying hard at building something, and it didn't work, and I have no regret whatsoever. The worst is when you invest in an idea which for a very short period of time, sometimes because you're sort of pushed to make a decision very fast, like Lacy, and you sort of go, okay, well, it might work, and you go for it, and then the next day it's like, fuck, what have I done?
Right.
And those are the ones which are very frustrating. But otherwise, failure is part of what we do day to day.
Well, you're not going to do great things if you're not willing to risk failure. I think that's very well said. Everybody, big round of applause for Jeff Clavier. It's really well done. Well done. Great job, Jeff. And let me thank the folks here who've really helped out. Kieran Kalia is the managing editor or the editor-in-chief. I don't know. Something. She runs Launch.co. If you guys read Launch.co, and she manages the show and does an amazing job. Big round of applause for Kieran. Brandis and Jesse on the gear over there. Every week you get that beautiful sound from these great microphones. It's not done without a lot of effort by Brandis and Jesse. Big round of applause for them. In the back, Jason DeMont paying the bills. He's our head of sales and gets all these great sponsors here. Big round of applause for DeMont. And then I'll just wrap up all this great applause with a big thank you to our friends here at Rocket Space and My Turnstone, who actually furnishes this place with gorgeous stuff, and New Relic for being our sponsors tonight and making this possible. Great job. Thank you so much, Rocket Space, especially for hosting us. This is very well done. And I want to thank the audience particularly because you guys did me proud. Great questions. Really, honestly, like I could have stopped the interview half an hour earlier and just let you guys ask the questions. How many people here have watched more than 5 episodes of the program, may I ask? How many people have watched more than 25 episodes of the program? Holy cow, I've got super fans. I got to tell you, how many people have watched, don't lie, how many people have watched like over 50? Okay, people need to get alive.
Get alive.
I got you. No, listen, I have to tell you, some of the best moments I've had over the last 3 or 4 years is the privilege of being involved in these conversations with great venture capitalists, angel investors, entrepreneurs. This show is like my favorite moment of the week, and getting to see you guys here live, the people who watch the show, it really, it's very touching to me to have you guys come out for the show, and I hope we can do this every month with bigger and better guests. And I really appreciate all you guys who tweet and everything and ask and harass people to be on the show. I particularly like that move. So the people who are out there harassing Mark Cuban and Elon Musk and Mark Pincus, all my friends who haven't been on the program yet, keep harassing them when you see them live in person. Tell them, why haven't you been on the show? That's always great. If you see somebody walking down the street like Chris Sacca or Jeff, just yell at them like, I heard you on TWiST, you were on TWiST. Just like yell at them. It's really funny. Like they come to me and like.
And it's much better than, hey, I saw you on Bravo.
Yeah, exactly. Oh, yeah, that's bad. Well played. All right, thanks everybody. Great job.
The raffle.
Oh, the raffle, yes. Okay, and big round of applause for Rocket Space. I want to get them one big round. Okay, now. Somebody is going to win either lunch or dinner, depending on the situation. I should pick here. You told me it's the one that's bent over in the ear? This one that you bent over on the side before? Okay. Here we go. Okay, your ticket number is, the first number is 0. The next number is 8. I think everybody here has 08 as the first number. 5. 5. Raise your hand if so far you're doing good. Oh, it's going to be good. 2, raise your hand if you're good because there's only one left. Well, it might be between just 3 people here. And the last number is 1. You won. Awesome. Well done. Well done. So dinner lunch, potentially dinner if you play your cards right with Mr. Jeff Clavier. One more time for Jeff Clavier.
Thank you. And just join me in thanking Jason for being such a grateful host.